Hello and good morning, everybody, and welcome to the second webinar in our series this year. So my name's Darren Perry, for those of you that don't know me. I'm a director in our not-for-profit team based in our Truro office, and I'm going to be chairing today's webinar. So if we look at the agenda, so we've got two main sessions today. Firstly, we're joined by Kirsty from our VAT exemption. And then we're also joined by Tamara and Lanny from our employment tax team, and they're going to take a look at some of the ways to mitigate the cost of employment taxes, such as through salary sacrifice and the trivial benefits exemption. In terms of the slides for today's sessions, everybody who's attending will be sent both a copy of the slides and also a link to the recording, should they wish to access it again, and that will be emailed out once the webinar is complete. We're also planning to do a questions and answer session with our speakers at the end of the presentations today. So if you do have any questions that you want to ask, on the left-hand side of your screen, you should see that there is a Q&A option, and you can type your questions in there as we go through the presentations, and then we'll do our best to pick up as many of them as possible at the end of today's sessions. So without any further ado, I will pass you on to Kirsty, who's going to look at VAT. Thank you.
Hi, so I'm in the VAT team and I specialise in not-for-profit and education sector. And if we go to the next slide, I'll talk through a bit more detail. Again, so as Darren said, partial exemption. So this impacts most charities that are VAT registered because VAT legislation allows you to have an exemption from paying VAT on some of your income, such as fundraising, care, sports, education. And that exemption therefore means that you're disproportionately impacted by requirements to do partial exemption calculations. We'll look at what that means, just a high-level overview, look at what impact the VAT recovery has, and look at common mistakes and risks. Then we'll do the general VAT updates, and finally then we'll just look at quickly the two VAT changes in the spring statement recently. So first of all, I love this slide. This is the simplest way to think about partial exemption. So the partial exemption calculation that any VAT registered charity will need to do when they've got exempt income is sort of basically listed here. And the easiest way to think about it is you're looking at your incomes, your total income, and then you're working out from your total income what that taxable income is. And that percentage, so say you have 50% exempt supplies that are sort of care and fundraising, whatever, and 50% taxable supplies, whether you've got a shop, etc., that got zero rated and standard rate supplies, so you've got 50% taxable supplies that you make. That is your top line starting figure, your income generation, and then you apply that to your purchases. So essentially HMRC won't let you have any VAT back on costs incurred in monies where they're not going to make any VAT on it. So essentially any of your exempt income, fundraising, etc., any expenditure related to that, generating that exempt expenditure, is automatically blocked from VAT recovery. You then got your taxable related expenses, so all the expenses where you know they're directly related to taxable income where VAT's going to be paid on at HMRC, say yes, you can have all of that back, that's fine. But then there's this mixed pot or residual or indirect costs, whichever term you like, which is neither completely related to taxable generating income or not completely related to generating exempt income. And that pot residual, you can only have a proportion. And so that top line where I said about total turnover to taxable turnover, your 50% in the example I gave, essentially really high level, you can have 50% of that mixed pot residual recovery. And so that's a sort of simple way of looking at it. And then there's like a de minimis calculation to carry out to work out if actually you can have the blocked, they might let you have the blocked VAT on the exempt supplies. But essentially that's a sort of high level way of looking at it. But obviously, as you can see, that's a lot of administration burden and work for small charities that are VAT registered to have to deal with. But essentially it's a requirement. You have to, if you're making exempt supplies, look at your expenditure. So what does that mean actually when you're trying to do the calculations. So next slide, please. It means you need to think about your expenditure. We've talked about that top line income, total income to taxable income. You now need to think about your expenditure. So when you've got an expense, you need to think about what it relates to. So we always recommend that those doing purchases, speak to the person that's going to be doing the bookkeeping to let them know their purchases, what they relate to, because you need to think about not just is there VAT on that invoice, but you need to think about what that invoice, what it's going to relate to in terms of income generation, if anything at all. So you need to know at that point that recovery if it's like to be a loss. So you can know, if you know it's for an exempt fundraising event where you're going to incur that cost and you're not going to be able to recover any of it, then you can already know that's a cost, that's an irrecoverable cost of VAT that you won't be able to recover. So you need to think about that's directly and wholly relatable to that fundraising activity event. There's only going to be exempt fundraising there. That's directly related to exempt, you can't recover it. You might have another purchase invoice come through where you spent money on say, a special event, which is going to be taxable admissions and going to have taxable events going on. It's generating income, but it's not a fundraiser. And that income, you know, you're going to be paying VAT on all of it. So you know it solely relates to taxable generating expenditure. That is wholly related to that. You need to make sure you know that when you buy it. You need to let the person know that's going to be put on the system that that's directly and wholly relatable to a taxable activity, and that can then be recovered on it. And then everything else, things like advertising, accountancy fees, all those sort of general overheads where it's neither one activity or another, that goes into a mixed pot, into that residual in that middle circle where we apply the percentage proportion we mentioned at the beginning. So think about at the time of the expense what it relates to, not just if there's VAT on the invoice, but what it actually relates to. Can you say it relates to this income generation or this income generation? Let the person know, and they need to know to put it on the system properly. What does that actually mean when you've got your VAT recovery? Next slide, please, Saffron. So what that actually means is what happens to the VAT afterwards when we get further down into the partial exemption. So at this point, you've made the expense, you've said what it relates to, it's going to go on your software system or your bookkeeping before the partial exemption. First off, you've got to think about the costs that relate to charitable activities, so non-business activities. They need to be taken out of the calculations at the beginning. They're normally coded to no VAT, unless you've got a non-business business apportionment method, which we will mention later on. As I said, anything where you know it's relating to income where you're going to account for VAT on it, or where it's zero rated. So you might have shop sales, and in that shop you might sell food that's zero rated, and you might sell food that's standard rated, and other standard rated items and zero rated items. But that shop, as you know, everything in it is taxable, and you know it relates to that. That's all recoverable. All that VAT that you'll get incurred is recoverable. Everything that relates to the exempt income, whether it be an education event or something else where it's exempt, that is irrecoverable. And then we've got the pot again. So I'm just repeating to get it, because it's really, people really get lost in this. Then you've got anything that doesn't relate to anything in particular where you can't split it out, you just cannot see for definite where it goes. That then gets put in this mixed pot where we're going to apply the percentage when we do the calculation. So if we look at the next slide when we do the calculation, so the actual calculation itself, we've entered everything on the system, you've worked out what it attributes towards expense-wise, you've put it on the system, so you might have coded it depending on your software system. So you might have coded it to 20% direct, and you might have then recorded it to indirect 20%, and then partially exempt, for example. You've coded it on the system. You then do the partial exemption standard method. So you look at your total income for the quarter, and then your taxable income for the quarter. That gives you a percentage. And if you're using the standard method, most people are applying the amount that they've got on the previous annual adjustment. So you might be applying 50%. And that 50% is applied to that pot residual. If at that point, excuse me, it's the input VAT that relates to the exempt expenses is less than £625, and less than 50% of all the VAT costs incurred, then you can meet the de minimis test potentially, and you can potentially recover all the VAT, including that blocked relating to exempt expenditure. So that's a really simple overview of a partial exemption for a quarter. It's really essential that you do the annual adjustment as well. The annual adjustment is required to be carried out in the quarter for the standard year end, so that will depend on your VAT return stagger. So say your VAT return stagger is January, March, September, December, then that would be March year end, and then you would account for it. You can either account for it in that same quarter, but most don't. You can include it in the June return and so forth. So the annual adjustment is required, and the reason it's required is because use can change over time, and that's why we normally suggest that you do the de minimis test more at that point, at the annual adjustment period time. And that's because there could be change over time about what your costs relate to. So for the yearly test, it's 7,500 exempt related VAT expenditure. So you've got VAT on exempt related expenditure less than 7,500, and then less than 50% of your total input VAT that year, then you're normally de minimis. And if you're de minimis, you can then recover all that blocked VAT. You might have had a change in income streams, so something might have happened. You might have opened another shop and have more taxable income, and that might have changed. So you might have been using a 50% recovery for that mixed pot all throughout the year, and then at the end of the year, you've opened another shop, and so your taxable income might have shot up to 60% or 70% taxable, and then that annual adjustment would allow you to claw back any VAT recovery because your taxable percentage has increased. So the annual adjustment is really key, and it's really important that you carry it out in order to make sure that you're not losing out on any VAT recovery that you can have. Next slide, please. I've included this as a sort of more simple example because you will get sent the slides afterwards. This was, everyone's using AI now, the idea of, I asked AI to give a fun and simple example of partial exemption. And as you can see here, they've used the smoothie shop analogy, and they've looked at treating magic smoothies as taxable, where you're going to account for VAT on those items, and mystic elixirs, which are exempt from VAT. And as they've explained, you might buy ingredients, and those costs that relate directly to the magic smoothies, because they're taxable, you can recover the VAT on. And those that relate to elixirs directly, you can't recover the VAT on. But all the other ingredients that are split, you need to work out how much VAT you can recover on. Their example, your mystic elixir sales are 30%, whereas your magical smoothies are 70%, so you can recover 70% of your mixed ingredients. We'll ignore the fact that a lot of the ingredients are actually zero rated in the first place, and I would imagine that smoothies, health drinks, are unlikely to be VAT exempt, but it's a fun example and it might help take you back to the beginning. So if we just go through the common areas and risks and things I would recommend people look at. First of all, if anyone comes to speak to us and asks for a VAT review of their income, of their partial exemption, we always ask, have you looked at your income streams lately and checked the VAT treatment's correct? Because that top line percentage that gets used for your mixed expenditure, that is all determined by your income streams, your total turnover to taxable. So if your income streams are treated incorrectly in the first place, then you could be either recovering less VAT than you're entitled to, or you could be paying VAT on income you shouldn't be, but overclaiming your VAT. So it's really important to make sure that actually your VAT treatment of your income in the first place is correct. And you know, it's the starting point, because that determines your VAT recovery of the middle mixed area expenses. As I mentioned before, you have to remember about your business, non-business input VAT. Non-business VAT you can't recover, you're not entitled to recover it. So if you don't have a business non-business apportionment method, then you need to not be recovering your input VAT on the non-business expenditure. Non-business expenditure is things like grant income, donation income that's solely expenses related to that, where you know it's like that. And there's different methods you can do with your business non-business apportionment that can be beneficial to look at, whether you can do it staff-based or floor-based. You can always speak to us about that, but it's a common area that you need to make sure you take it out. And in fact, if you're not doing if you're doing a mixed method, the de minimis rules for partial exemption fall in the first place as well. So good idea to review that and think about the whole thing. I probably overwent on about it, but it's really important that you understand what the expenditure relates to. If you don't understand how it relates to the income, then that's going to be where you fall down, because you might post it to being related to exempt when it should be mixed use, or you might post it to mixed use when it should be taxable. Really talk to each other, make sure there's a more communication, that you let each other know what the expense relates to, so people have got an understanding of what the costs are when they're putting them on the system. Coding issues, they sort of follow on from understanding what the expense relates to. You might have had a supplier set up a long time ago that only gave you suppliers that related to your exempt income. Things might have changed. They might be doing suppliers that use mix now, so it might be coded wrong, or someone didn't really understand when they entered the new supplier on the system and they've been coded to indirect into the mixed use, the pot, when it should have been directly attributable taxable. That could be losing you money. So review of codes, making sure that understanding of where the purchases should go, really key. Really need to do the annual adjustment. That really does make a difference if you haven't done it. Unfortunately, I meet a lot of not-for-profits that don't do the annual adjustment. Really important to do that, because things change. We often get clients' money back when they do the annual adjustment, but if you don't do the adjustment in the first place, you might find yourself losing out, and you might find yourself in trouble with HMRC. Do you need to carry out a review? You might have a partial exemption that seems really neat and tidy, might have been doing it for a long time, but is it in your best interest? Does it need reviewing? Do you need to look at partial exemption special method, which is sector-based? Always a good idea to sort of have a think about and make sure you're not losing out on any VAT recovery. And that's partial exemption. Quick, really high level, quick run through. So looking at the general VAT updates, you'll notice there's way more than last year. Maybe shows a change of focus from HMRC with the need to get money in for the Treasury. So first off, I would hope that any of you that are impacted by this will have already either heard from us or from HMRC or from the charity tax group, but there have been nudge letters being issued to any not-for-profits under 2 million turnover to remind them about the requirement to do a business non-business apportionment method, or not recover your VAT on your non-business expenditure. So it's just a general reminder. Really need to think about that. Doesn't matter what size you are. Are you doing the best method? As I mentioned, there are other methods, staff-based, floor-based. It's a good opportunity to maybe think about that before the nudge letters come out, and for larger charities. The HMRC consultation is now open for business charity donations. That's until July the 21st. I really would recommend that if you're a charity that receives a lot of donations from businesses, that you feed back. Essentially, businesses are sort of penalised for any large amount of donations. The reliefs on giving donations are very small. They tend to be on exports. So anything over £50, they normally hit a requirement to account for output tax, or impacted by the blocking of the VAT recovery on the cost. So the idea of this consultation is to see what other reliefs can be put into place to allow businesses to give larger donations to charities. So you really need to think about feeding back if you do in fact get a lot of donations from business. The other update was the VAT groups providing care, and this was sort of smuggled out in amongst the spring statement, the Revenue and Customs Brief 0225, and this only impacts anyone that's providing care and is registered with a regulatory body such as Care Quality Commission, and those in a VAT group registration. So if you're in a VAT group registration and you've got one entity that's, say, CQC registered, and they're providing care maybe to individuals and treating them as VAT exempt, and then you've got another entity within the VAT group that's not VAT registered, that is VAT registered, sorry, that's not CQC registered, and they're providing care and charging VAT on those supplies. That is essentially the tax avoidance that HMRC are looking at. So this was a scheme that was pushed by advisors, and lots of local authorities also asked providers of care to enter this scheme. It's mainly for things like residential care homes. So residential care homes, typically majority suppliers obviously VAT exempt, CQC registered, their care is VAT exempt. So VAT recovery very limited, as you can imagine. And so the idea is that you have one entity that's not CQC registered. They can charge the local authorities or the NHS VAT. Those NHS trusts and those local authorities, because they're of VAT legislation, are able to recover VAT on non-business expenditure, so they can recover the VAT, so it washes through. The other entity in the VAT group is CQC registered, for example. They would treat their suppliers as exempt, and their suppliers to the other entity that is not CQC registered fall outside VAT because they're in a VAT group. That obviously increases the VAT recovery greatly. Because of that, HMRC have said it's tax avoidance now, and anyone doing such a scheme needs to review the scheme and check how to get out of it, speak to their advisors, contact HMRC. I would hope if you're operating any of that scheme that you've already been contacted by the local authorities, because they're being pressurised to correct it from their side. The other big change, and probably should have updated this, Charity Tax Group and others were pressurising HMRC to update their guidance on fundraising and when the VAT exemption could apply. And this was because the Yorkshire Agricultural Showcase, where they'd been treating their admission fees as taxable, accounting for VAT on them, and someone, obviously an advisor, pointed out they probably met the fundraising exemption and could be exempt from VAT, so they put in error corrections. And finally, at the upper tier tribunal, it was HMRC lost, and it was agreed that Yorkshire Agricultural Show could treat those admission fees as exempt fundraising income and get their money back. So the pressurised approach to HMRC was to give more guidance on what they considered fundraising to avoid these costly tribunal cases that seem rather ridiculous. The RCB came out actually on the date of the live charity webinar, so there is guidance out. I would say the brief does not provide much more change than the normal fundraising rules, so it's probably just a reminder, and I do try and say this to a lot of my not-profits, that you need to remember what the fundraising rules are. You can't just say something's fundraising because you're generating income and it will go back into the charity. It has to be the prime purpose of the event is there to generate fundraising income. You can have other things going on, and that was the argument with the Yorkshire Agricultural Show, that there was other purposes of the show, but the main predominant purpose was actually exempt fundraising. Just because there was other things going on, such as education, didn't mean that it couldn't fall into the fundraising exemption. But be mindful of the 15 rule, events a year rule. If you have more than that, it doesn't meet the fundraising exemption. If you're in direct competition, so say you have I think the common one they use in the examples are normally the boot fair one. If you have a boot fair every week and that is next to somewhere else that could be having a boot fair, then you're placing unfair competition. So just a reminder that it has to be held out. That has to be the predominant purpose. Familiarise yourself with that, because it is a tricky area. And the fact that HMRC argued this shows that they, even though we might all think the guidance is clear, they are still arguing against things being fundraising when you would think it was. So always be mindful of that HMRC come back and question. So we've got the spring updates next. Next slide, please, Saffron. Okay, so some of you may remember from last year if you attended, and for those of you that don't know or not aware by past year, the VAT rules changed on late payments of VAT in January 23. Prior to this, HMRC could choose to not charge you interest on late payments of VAT. Late payments of VAT being late payments of your VAT return, or late payments because you've made an error and you have to submit an error correction notice, or late payments because they've found an error and they raise an officer's assessment. Those late payments of VAT are all subject to VAT to interest since January 2023, and this was as a result of the late filing, late payment penalty system coming into place to replace the default surcharge regime. And the late filing, late payment filing scheme is to match the self-assessment and the other schemes to make it all work in the same way. And because of that, the interest is now chargeable. The interest, as you can see, from 6th of April has gone up significantly. It was already quite high. It's now Bank of Interest rate plus 4%. It's a lot of money if you make a mistake or you have to file your return late. The repayment interest, if you'll notice, is Bank of Interest rate minus 1%. So if it's money due to you, it's a lot less. There's also penalties if you still haven't paid at day 15 and day 30. So we would really highly recommend, where it's a VAT return and you're unable to pay it all, pay as much as you can and try and get a time to pay. But predominantly, just be mindful if you make an error on a VAT return, it's really better to correct it as soon as possible, because those interest rates apply to error corrections and to officer's assessment. So it will go back to when the VAT should have been accounted for. That's when the interest applies from. So if you've made a mistake in this April, and it's say in your May return, but you don't notice, or you do notice but you don't correct it for like 2 years, that's 2 years interest at that 8.5%. So it's really important to correct any errors as soon as you see them. Next slide, please. Okay, so the other major change, they haven't said they're definitely doing it, but they've said they're considering it. So I would imagine it will come in one format or the other. So the capital goods scheme is a scheme that is in place for large purchases of a land or property or large expenditure on, fixtures or fittings, amending, refurbishments of land and property. £250,000 plus VAT, and for computers, 50,000 plus VAT. The idea of CGS, capital goods scheme calculations, it allows for you to recover the VAT based on your usage. So the idea is that you might have, say, spent a lot of money on, say, refurbishing a building that's going to be used, and essentially at the beginning of the use there might be 50% exempt use of the building and 50% taxable related use, and so you might only be able to recover 50% of that VAT on that cost of the refurb at the beginning of the CGS calculations. But the CGS calculations are over 10 years, you do one each year for 10 years, and so you might find 3 years down the line that actually your use of the building has increased to 70% and 30% exempt. So actually it allows clawback. The CGS calculation allows clawback because actually you're going to be using it more for taxable going forward. So the CGS scheme can be quite beneficial for not-for-profits where the usage might change. The idea here is HMRC haven't changed that value though for a long time, so they're looking at increasing the value for the land and property threshold from 250 to 600 to £1 million plus VAT, and removing the CGS from computers altogether. Obviously, this is a big impact because not-for-profits already incur VAT that they might not be able to recover on large refurbs and property costs. So you really need to plan even more so now when you've got a big project planned if they bring this in, because, for example, if the item doesn't fall into the CGS, say it's under the £600,000, then the VAT recovery will be based on what your usage is at the time of the build. So you really need to think better about the planning, about actually long term, what will it be used for. So with any large project, we would always suggest making sure you think about the VAT recovery before you sort of take the next step. It can also make an impact on, say, if you're getting grant funding such as Heritage Lottery funding and everything, they will often fund irrecoverable VAT. So it's really good to plan the VAT recovery and the costs and the impact before the project starts to make sure you can find other ways of getting the VAT back if you can't cover it all. And that's it from me. Any questions in the chat later on?
Perfect. Okay, great. Thanks, Kirsty. That was great. So as a little bit of an introduction to our section, so my name is Tamara. I'm a manager in our employment tax team. I'm joined by my colleague Lani here today, and we are going to talk about just a few hot topics really in the employment tax world, things that we thought might be relevant to your charities. So just as a bit of an agenda, we're going to start off with myself talking about salary sacrifice or salary exchange. So as you're probably all aware, from April this year, national insurance for employers increased. So we're going to be looking at whether you could using salary exchange, or whether you could use it to potentially reduce your employer NI payments and make savings for your employees. Payroll and benefits in kind. As some of you may or may not be aware again, we've now got an extra year until the payrolling of benefits in kind becomes mandatory, and that's from April 2027. But we're going to look at what the risks potentially are and how to prepare for that switch in the future. And then finally, Lani is going to take the topic of trivial benefits for us. So a number of years ago, HMRC introduced trivial benefits for non-cash items of less than £50. Lani is going to talk about what the opportunities are with this rule, and then what essentially you might want to consider avoiding if you're going to make use of that. So that's just, as I said, a quick fire through our agenda today. And then as a little bit of an introduction, I just wanted to talk a bit around the scene and background at the moment for you as employers and in the world of increasing costs from the employment tax angle. So as I mentioned previously, national insurance increases. The main rate of national insurance for employers has increased up to 15%. The threshold for employer national insurance has decreased down to £5,000, which essentially means that employers are going to be paying more in national insurance for individuals that they employ, which is not great. We've also got national minimum wage and national living wage increases. So the minimum wage for over 21s rose by 6.7% in April of this year. So if you consider someone that might work a kind of standard 37.5-hour week, that equates to more than an extra £1,500 per year. So that's quite a lot per employee. You've also got employees under 21 and apprentices that have also seen increases. And along with employees maybe a bit further up the pay scale, who may also expect similar increases to preserve the relative value of their salary. So it's all relative, and it does impact employees across the board. And then finally, frozen tax thresholds. So we've had the freeze on income tax thresholds is set to continue until 2028. What that really means for employers, essentially any future pay rises over the next few years will face a higher burden of tax. In real terms, really increasing the pressure on employers to provide above inflation pay rises. So that's kind of the main background there, just to set the scene and kind of explain why we're considering these different options to help mitigate these increased employer costs. So if we just flick on to the first topic then, so salary exchange or salary sacrifice, the terms can be used interchangeably. From a semantic side, people may prefer exchanging rather than sacrificing something. So it might be something you want to consider in your communication to employees if you do want to put this in place, or you do already. But if we just pop on one more, please, Saf. So salary sacrifice, a strategy to mitigate employer cost increases. So essentially, it lets an individual exchange some of their wages for a different benefit from their employer, like a company car or pension schemes. The key thing to remember is that essentially the employee's taxable pay is being reduced, and that is really most likely to be beneficial for the higher earners, but it does result in significant savings for employees and employers. It's probably most used really in relation to pension schemes. A lot of clients that we work with recently have kind of suggested there's a little bit of a no-brainer really. Some admin at the start, but it does tend to pay itself off. But you've also got maybe a cycle to work scheme, electric vehicles. As I said, the main kind of popular popular one is pensions, and that's where we see probably the most activity and interest from our clients. So if we just pop on one more, please, Saf. So what are the benefits? As you can see here, I've tried to split it into employees and employers just to make it quite clear for you. So from an employee perspective, you've got lower national insurance contributions, so essentially helping employees keep more of the earnings. Hand in hand, a lower tax liability, so reducing gross salary, lowering an employee's income tax liability. Employees are going to be saving money on their tax bill. And then access to non-cash benefits. So it might enable employees to receive non-cash benefits that they might not be able to afford otherwise. So those are really the key benefits from an employee perspective. On the employer side, you've got reduced employer national insurance. So employers are lowering the tax bill, saving money on national insurance, because of no national insurance or tax needs to be paid on the salary that's sacrificed. So the employer there has a choice whether they want to retain that national insurance saving, or whether they want to pass that on to the employees in the form of an increased contribution. So thinking about pensions there, you may want to increase pension contribution to pass on that saving, but that was obviously entirely dependent on the employer running the scheme. The next two really go hand in hand, so increased employee satisfaction and improved recruitment. It's often seen that offering salary sacrifice can improve employee satisfaction and retention. It's often seen as a valuable perk, and it can attract talent as well. Is often seen as quite a key part of competitive benefit package for people looking for work. So all positives really on both sides there. Moving on now then, as I've kind of alluded to previously, pensions really are the biggest area where we see the interest in salary sacrifice, and it is really an area where the biggest savings are seen. So here on the slide, we've got a little bit of a wordy example that I won't spend too long kind of trawling through, because I do have a numerical example as well. But just to kind of paint the picture here, you've got an employee that may currently contribute 5% of their salary that they'll obviously get tax relief from, and their employer contributes 3%. So under a salary sacrifice or salary exchange scheme, the employee will agree to be paid 5% less salary, and the employer will agree to contribute 8% into the employee's pension scheme. So essentially, the employee contribution becomes that of the employer. Employer provided contributions are exempt from tax, national insurance, and the apprenticeship levy. As a result, there you've got the employer and the employee ends up saving national insurance. So you've got 15% for the employer and 8 or 2% respectively for the employee, depending on the marginal rate there. So that's just a kind of quick wordy example, as I said. If we just flick on one more slide, there is a bit more of a numerical example there. So this is just an example, but it shows what is in place before a pension salary exchange and what is in place after. So your pension contribution is taken out of the gross, so that's before tax salary, reducing down what is ultimately taxable, and in this case, what is also liable to national insurance. As I said, the employee contribution becomes that of the employer. If we kind of jump down, you can see that you've got savings there for employees of £120 and employers £225 per year. So it's not huge, it's not thousands and thousands of pounds, but if you've got a large workforce and you're looking at a saving like this per employee, then you know these savings definitely do add up, and it might be something that you might want to consider going forwards. As I said, it's really an area that we've seen a huge increase in interest around, and we have been making some significant savings for employers as well. So it's just worthwhile keeping that in mind. So jumping forwards again, please, Saf, there. If we just think about the rules, maybe the boring bit, the the hard line. National minimum wage. So employers cannot reduce or cannot use, salary sacrifice to reduce an employee's pay below national minimum wage. As I said, that's 12.21 an hour for employees over 21. Statutory pay. The amount of statutory paternity pay or statutory sick leave an employee is entitled through a salary sacrifice arrangement can be reduced. The statutory pay amount must still be paid in full, regardless of that arrangement. Pension auto-enrolment. So, as you're all aware, there's a minimum level of pension contributions for eligible employees under auto-enrolment rules. The full amount of the statutory pay must still be paid. A salary sacrifice can't be used to reduce that. Redundancy pay, again, salary sacrifice cannot reduce an employee's pay below the minimum or redundancy pay entitlement, and then tax and national insurance limit. So again, it can't be used to reduce an employee's pay below certain tax thresholds, which includes minimum amounts for tax and national insurance. So if we go on one more, please, staff. So that's kind of a whistle-stop tour through salary sacrifice and really just what that looks like and the potential benefits for your employees and you as potential employers. So as I said, it's just worth something just considering going forwards, and if you're something that you're interested in, then we could potentially have a chat independently and discuss things a bit more. My next topic, payrolling benefits in kind. So as I mentioned previously, employers who provide taxable benefits in kind to their employees will be required from April 2027 to report those benefits and pay the Class 1A national insurance due in real time via the payroll. This is all part of HMRC's plans to simplify and modernise the UK tax system. If we just go on one more slide, please, Saf. Just as a little bit of an overview, what is a benefit in kind? It's essentially remuneration that's been paid to an employee which is not paid to them in cash. Some employers see it as a cost and tax effective way to incentivise and reward employees. So it is, as I said, quite popular. Most employers tend to provide some form of benefit in kind. Examples there, you've got cars, accommodation, loans, health insurance. So yeah, if there's something that is provided and maybe reported on a P11D currently, then those will need to be reported. And as I said, the Class 1A national insurance paid via the payroll and the tax as well. If we just flip on one slide, please. So what is happening? As I said, from April 27, these benefits need to be reported to HMRC in real time via the payroll. That'll be done via the standard just full payment submission that's submitted to HMRC following each pay period. So most likely months for monthly paid employees. The employer will have the responsibility to calculate the cash equivalent value of the benefit, likely calculating the yearly value and then dividing that figure by the number of pay periods in the year, and that will be the amount that needs to be taxed and run through the payroll each period. If there's any changes to a benefit amount throughout the year, then that amount can be adjusted. As I said, that will just need to be a new cash equivalent calculation that need to take place mid-year, and the adjusted amount then processed thereafter. With some limited exceptions, the P11D and the P11DB will no longer be required. That may or may not be a good thing depending on how you feel about payrolling benefits in kind. There are some exceptions, as I said. So where interest-free or low-interest loans are provided to employees or accommodation is provided to employees. Currently, those are the two only benefits that are expected to fall outside the mandatory payrolling benefits in kind regime. So those can still be reported on a short form P11D and P11DB from April 2027, but those are the only exceptions. It has been suggested that the government might make the payrolling of those benefits mandatory in future, but we're not expecting it from the outset. So that's just something to consider going forwards. So if we just go forward one slide, please. A key question probably is why. So why is this happening? As I said, part of HMRC's plans to simplify and modernise the tax system. That's their words, not mine. Really, it's looking at streamlining tax collection and real-time tax deduction means, or hopefully will mean, fewer year-end adjustments. There are a few steps to implementation. If we just pop on one more slide, please. Registration, planning, systems and software, communication and exclusions. So yeah, registration. For the mandatory payroll and benefits in kind, it may be automatic after April 2027. This is a bit of a grey area, waiting for some clarification from HMRC on that. If you are considering voluntarily payrolling benefits in kind prior to April 2027, so we've got this extra year because the mandatory payrolling benefits in kind was pushed back. It was originally supposed to come into force in April 26. We've now got an extra year, but you might want to consider payrolling benefits in kind voluntarily in that extra year, so in April, from April 2026, just to kind of get things started and just to have a bit of a test year really before everything becomes mandatory. Systems and software, checking that your payroll software is up to date. Are you able to integrate those cash equivalent values into pay, and then communication to employees. There is certain information that needs to be provided to them. And then, as I said previously, you've got your exclusions for loans provided to employees and accommodation. Just jumping back really to voluntary registration, because I do think it's quite a key point to think about. It will be it should be a really good chance to test the system and make sure that all of your processes are able to deal with the payroll and benefits in kind. It's not just the physicalities of software, so whether you run a payroll in-house or utilise an external party to do that. It's thinking about how information is conveyed between different parties. So who's going to be responsible for collecting benefit in kind information? Who's going to be calculating the cash equivalent values? How's that going to be communicated to the person that actually runs the payroll? These are all just kind of key things to think about. If you are potentially interested in voluntarily payroll and benefits in kind, so let's say from April 2026, you'd want to make sure that you are registering with HMRC to do so nice and early. So I would probably say, probably prefer a registration no later really than, let's say, December of this year. That just gives HMRC plenty of time to get things right on their end. So it should hopefully avoid employees getting multiple tax code changes because they'll already know what benefits are going to be payrolled for that individual in advance of processing updated tax codes for the 26-27 year. And it also gives the employer some time to make sure that they are all prepared. So if we go forward one more slide, please. So what should employers do? I probably already talked around this a little bit, but as I've mentioned, checking software doesn't meet the functionality requirements that are needed to payroll benefits. Employee education. So employees that receive payroll benefits, whether it's voluntary or mandatory, will need to check their pay-as-you-earn code just to make sure that any adjustments relating to the benefit that now being payrolled is being removed, and there's no issue of any double tax on there. In terms of communication with employees, are they aware of the impact on their net income? Could this potentially cause any cash flow issues? I mean, it would be a surprise unless you have individuals that are receiving very high value benefits in kind, but it's just something to consider. Are you aware that all benefit data throughout the year needs to be accurate, reliable and available in plenty of time for the payroll reporting so it can be processed? if there's errors that could result in potential penalties and potentially have a direct impact on the net pay of your employees in future. So it's just worth considering and making sure that you're ready. On the topic of penalties, HMRC, it's been suggested that they won't, come down very harshly at the start of all this. So yeah, it should be fine for at least a period, a bedding in period. There will be some grace for employers for things not to run 100% smoothly, but for the sake of your employees, I'd always suggest that testing and being ready is definitely worth it in that light. And then, yeah, finally, is it time to review your overall benefit offering? Just making sure that you're ready. Possible complications, as I've kind of alluded to so far, tax code changes. Employees don't like tax code changes, and it can be quite frustrating if they come to the employer rather than HMRC to ask why things have changed. HMRC should remove the value of the benefit in kind from the affected employee's pay-as-you-earn code to avoid any double deductions. As I said, that's a really good idea to voluntarily register to payroll benefits kind of nice and early to remove any potential frequent tax code changes which could potentially happen. So yeah, thinking about decreases in employee pay and just making sure that if there is going to be a significant decrease in an employee pay, so like sick leave, maternity leave, paternity leave, it may mean that it's no longer appropriate to payroll that benefit. So you just need to think about that. You may not know the benefit value at the start of the tax year, and in that case, a reasonable estimate can be used, but that would need to be adjusted as soon as an exact value of the benefit is known. Optional remuneration agreements can be problematic because you'd need to understand the value of the benefit that's going to be used. So thinking about the higher of the salary forgone or the cash equivalent, I just advise care to be taken in that regard, and potentially getting professional advice if there is any confusion in that regard. Do not underestimate the payrolling benefits in kind. It's a very simple concept. It sounds like it should work well, and fingers crossed it will run quite smoothly. But the fact that we've already had a year pushback does suggest that things are not potentially where they need to be for this to be completely pain-free. So yeah, just don't underestimate how complex this is like to be, how many parts of your organisation that might be affected, or and then how long it may take to bed in. So that's everything from me on the benefits in kind. I'm now going to pass over to Lani to talk you through trivial benefits.
Yeah, so if you could just pop on to the next slide, sorry. So following on from the discussion around benefits in kind and kind of ways that employees can lessen the tax burden, an important exemption exists kind of in the form of trivial benefits, which are defined as a benefit with a cost including VAT of less than £50. If it's an event or a party, then it's kind of the average cost is less than £50 a head. It can't be provided under a salary sacrifice agreement, even if it's classed as a trivial benefit because it's under the £50. If it's done under salary sacrifice, it still wouldn't count. It can't be cash or kind of a cash voucher, so gift cards are always preferable as long as they cannot be surrendered for cash. And the employee cannot be entitled to the benefit under any sort of contractual obligation. And this includes sort of any reward for services. So if it's given to them by reason of their performance at work, it also wouldn't be caught under the exemption. In most cases, an employee can receive multiple trivial benefits throughout the year, as long as each one does not exceed £50. But where the employer is a close company, the exemption is capped at a total of £300 if the benefits are provided to a director or office holder of that company. So if the £50 limit is exceeded, then and it's no longer caught under the trivial benefit exemption, the entire benefit becomes taxable, not just the excess over the £50. So for employees, this would mean the entire benefit would be subject to income tax, national insurance, reported either by the payroll if benefits are payrolled, or on the P11D. And for employers, the business would need to pay Class 1A national insurance on that value of the benefit. So to kind of avoid that, the benefit should remain under £50, including VAT. So if we go on to some examples, yeah, so some key examples are birthday gifts, chocolates, flowers, things like that, a meal out to celebrate a birthday, a wedding, something like that, provided the average cost per person is less than £50 a head. Seasonal stuff, so like a turkey, a bottle of wine. The exemption also covers those kind of things provided at work, so like tea, coffee, snacks. The reason those aren't kind of a benefit on an employee is because they're covered by the trivial benefit exemption. Easter eggs, and recently we've been seeing the kind of provision of kind of ad hoc food stalls vans. So employees can go and have their lunch from this van. I think if we go on to like what isn't included, the key thing to be worried about with the provision of food stalls and things like that is that anything provided frequently or regularly where there becomes a legitimate expectation of its provision is no longer covered by the exemption. So if it's a weekly thing, for example, HMRC could argue that there is now an expectation of its provision, so it's no longer a trivial benefit. So to avoid challenge, we'd always advise that these things are kind of done on a more ad hoc basis. Other things that you can't include in the exemption is anything contractual, long service awards, and this is because HMRC deems it to be related to the employment, so it wouldn't be caught under that. There are separate exemptions available for long service awards, but they're quite strict, so the employee must have worked there for at least 20 years. And they can't have received another long service award in the last 10 years. So it's kind of hard to get within that exemption. Anything, as we've covered, anything in reward for services. So often star awards or like employee of the month awards, that wouldn't be covered by the exemption because it's a direct reward for performance at work. And anything in connection with other things. So if you give an employee a £50 gift card and then the next day give them another £50 gift card saying that, oh, well, they're both under £50, HMRC would argue that they're linked and it's actually a £100 award, so it wouldn't be covered and would therefore be taxable. And then events with a cost per head of over £50, obviously there's the annual exemption there. So for Christmas parties and summer parties, there is an exemption that exists, which increases this cap to £150, but there are various criteria for that specific separate exemption. So broadly, like ad hoc events, if the cost is over £50, that wouldn't count either. So in summary, Chivalry benefits are broadly gifts or events provided to employees for a reason unconnected with their employment. It's a good way to provide small ad hoc benefits without incurring the tax and NI implications of standard benefits in kind, and particularly bearing in mind the cost of the NI increases and the minimum wage. It's a good way to give back to employees without having the burden of the tax usually associated with staff benefits or entertaining. And I think I'll pass back to Mara for an overall summary.
Fantastic, thank you. So yeah, I'm very aware we're very tight on time, so I will not really take too long in just providing, as I said, a little bit of a summary. But the 3 points that you've covered: salary sacrifice. It's a great way to trim tax and help employees keep more of what they earn. So if it's not something that's on your radar currently, then maybe it will be going forwards. Payroll and benefits in kind. We've got this extra year. It's a really good time to get used to the system. Potentially thinking about processes and employee communications in advance of that date that it'll become mandatory in 2027. And then trivial benefits. Are you currently making the most of the exemption there? And if not, how could you potentially do so in future? Thank you very much for listening to us. And as we alluded, if you have any questions, then feel free to drop it in the box, or you can just pop us an email directly. We can get back to you.
That's great. Thank you, Tamara. Okay, that brings us to the end of our webinar today in terms of the formal presentations. We literally have a couple of minutes left, and I did see there is a VAT question that has come in, so perhaps Kirsty, if you could pick that one up. So we've been asked, yeah, if you have monthly VAT returns, when does the annual adjustment have to be completed, and are there any particular deadlines for getting it done?
So for monthly, the annual adjustment year end is 31st of March. I would need to check. I can't find it anywhere whether it says you have to include it in that VAT return. So that would be due, because it's a monthly return, it'll be due when that March return's due. I need to check if you need another, if you get an extra month and get to put it in the next return, but I suspect not. So Kerry, if you wait, I will send a message afterwards. I'll get your details and send that after to check. But I would imagine probably that monthly return, the March 31st return, it would need to be included on that.
That's great. Thank you, Kirsty. Well, that brings us nicely to 1 o'clock, and I don't think we've got any more questions. Sorry, one's just been popped in there. So will there be a new process for PSAs under the payrolling of benefits?
No, that's a nice and simple one, and the answer is no. There is no process, so PSAs will be unaffected by the payrolling of benefits changes. Excellent,
thank you. Okay, well, it just leaves me then to say thank you to our speakers for today's session, and also for everybody attending. As I mentioned, the slides and recording will be coming out to you, and I hope you found the sessions useful. Thank you and goodbye.